and you. This is Helen Thomas and the CDFM Study Group. All right, today's session, we are going to be reviewing CDFM Module 3 in its entirety. So however far we get in the allotted time, we'll stop there. If we don't complete it, I will complete next week. And so we're going to begin, jump right into it. Let me get the admin things out of the way. If you have not already subscribed to our YouTube page, please, sir, please, ma'am, go ahead and click that button and subscribe to our YouTube page. The more people I can get to subscribe, the more the Google, the YouTube platform will then advertise it. So whenever people type in CDFM, study material, whatever, then our videos will come up. So please consider doing that. Also, make sure that you click the notification button at the top, because every time I upload something new, it'll send you a message, an email, to let you know that a new video has been uploaded. All right, again, welcome to the CDFM Study Group, and I am Helen Thomas. All right, so we said that CDFM Module 3 deals with finance, accounting, auditing, and fiscal law. And so let us start with the finance. We started off that session when we talked about the 4 functions of finance, financial operations. So you have entitlements, payments, collection, and control of public funds. Whenever you have a list of things, that means you need to know what right looks like. So if they push something else in that multiple choice and say, these are the 4 functions of finance, and they say entitlements, payments, collection, flow of funds, you'd be like, no, I think it's control of public funds. You get what I'm saying? So let's go down the list. So we'll look at each one of those functions in its entirety shortly. So understand, if they throw topics like budgeting, that is not a function of finance. As a financial manager, you are supposed to know the finance side of the house, where we pay people, pay for things. And you have the budgeting side, the resource management side, to be more specific. So when you certify a transaction, certification means you are accountable for that transaction and you are liable. So accountability plus liability equals certification. Or you could say certification equals accountability plus liability. So who is the primary DOD, because it's a DOD exam, the DOD finance and accounting person under the control of the USD Comptroller? That is DFAS. DFAS is the designated agent, and they act as an agent for the Treasury, but they also have the primary responsibility for DOD finance, DFAS, Defense Finance and Accounting Services. So they do that. So who has authority? The Secretary of Defense has statutory authority to dispense and collect funds for the Department of Defense. What is the title of the senior financial manager at the DOD level? What is the title of the CFO, Chief Financial Officer for the Department of Defense? It is the Undersecretary of Defense Comptroller, USD Comptroller. So depending on the question that's asked, make sure you're listening when you're reading a test. I always tell people, use one of these fingers and point at the words on the exams, because our mind tends to scan. And then when we see something we like, we just pick an answer, but that might not be the question that was asked of you. So make sure you read all the questions. So prior to making payments, the payment office must do the first function of finance, which is entitlement. They got to determine if that person is legally allowed to get that payment. So the entitling process, that's legally establishing the benefits, is authorized for that individual. So examples given was meal pay, travel pay, vendor pay, civilian pay. You do the entitling, but you have to have some type of supporting document, which we do in no matter what capacity, that entitles that individual. So it makes sense, right? Make it make sense. Entitling. And then once you are entitled for it, you must have an authorization document. That is your supporting document that required for a dispersing officer or a certifying officer to make a disbursement. So let me pause here because I got to go back to our Facebook because I have a question there that says, okay, I'm a little confused. What is the difference between a certifying officer and a dispersing officer? Dispersing is the person that's saying, this is how much this individual is owed. They are entitled to $5. This, based on the supporting documents, these are the funds that they are entitled to. Pay them. They actually disperse their cash. Your certifying officer is that next level of certification that says, okay, I've reviewed the dispersing officer's work, okay, and my cashier's work, or whoever is doing the actual packaging of the payment packet, and I've certified that, yep, they are truly entitled to these payments. So the dispersing person disperses the money, they're certifying the payment that going out. That's another eyes. Then the certifying officer is often certifying the packet, that everything is there to show that that person is certified. All right. Voucher preparation. So a proper disbursement, in order for you, the dispersing officer, to disperse, you must have the authority to make the payment. And so you have to have the right supporting documents. So proper vendor payment must be supported by four documents. When you're paying a contractor, you must have a contract. I'm not just going to randomly pay somebody. What is the legal document that says you, the contractor, are owed the payment? Then you gave an invoice triggering and letting me know that you have provided whatever you said you were going to provide in the contract through an invoice. Goods receipt is on the government side, us saying that we received the goods. And goods acceptance is I've evaluated, I've checked, I've made sure that it is exactly what I ordered and it's in good condition. Goods acceptance is now I'm saying, yep, I received the goods and I accept them as is. That's your vendor payment. Now a voucher, that's your payment voucher. So I get the packet in the vendor packet. Now I have to create a voucher. On the voucher, it has 5 elements. The heading and the date on the voucher. What does that include? So when you're studying, you want to tell a story. Your mind will remember easier if you tell it as a story. So in the voucher packet, this is the packet now that your certifying officer is going to certify. And when your dispersing officer get it to actually make the payment, then they also have to review it. So complete name, mailing address, paying office, the date of the voucher was prepared, what's your dispersing officer vendor number, and all of those information has to be in the header. You have to have where you're going to charge the money, where you're going to get the money for this payment. So accounting classification must be on it. What is the approved amount to be dispersed? How are we going to disperse it? Is it going to be electronic funds transfer, a check, or cash? Really, you're going to get cash these days. And then who are we paying? The payee must also be on that voucher. And so that is function number 1, entitling. Now we move to certification. Now I've got the packet together. It goes to the certifier. So that's like your supervisor, the next level up in that process. You got a process for everything. So certifying military pay entitlement. The defense regulation is DoD FMR Volume 7 Alpha that deals with finance and certification entitlements, all of that's in there. So a reservist with no dependents going to annual training and is assigned quarters can get partial BAH. Certifying. So when you're certifying, you're looking to see, okay, well, is this an active duty soldier, reservist? Are they entitled to full BAH, partial BAH? How much? Separation allowance? If they're separated from their family, who's entitled to it? Is it everybody, or is it just active duty when their military pay is calculated on 30-day month? Military receive 30 days leave in a year. So all of this knowledge, the certifier must know that stuff. So when they're certifying the documents, they're reviewing the documents, they must know the basic information behind this entitlement. And military pay, on their payment, they are entitled to 6 discretionary allotment and an unlimited non-discretionary. So discretionary allotment could be for military personnel is, I just bought a new car and I want my car payment to come directly out of my check before it hits the bank. So I start an allotment. That's discretionary. I did it as the military person. Unlimited non-discretionary, the perfect example is if you owe the government funding and the IRS has to take money out of your check, that is non-discretionary. Or if you owe child support and the agency has to take the money directly from your check, you didn't start it, so that becomes non-discretionary. And then when you move to the civilian pay entitlement, that's DoD FMR Volume 8, we're going to look at different aspects of when you deal with civilian pay that was not covered with the military pay. Whereas the military is paid on 30-day months, the civilian have based on work weeks. So they have 26 pay period within a year. And civilians are entitled to premium pay. Premium pay includes things like overtime, holiday pay, Sunday pay. So there are different types of pay, even though you may not experience them personally, but civilians are authorized. And typically they have to be approved to do things like overtime. There's some rules now. Let's talk about civilian leave. So I see you're on, Mr. Rodriguez. So if you have any question while I'm running through this, feel free to let me know, okay? Thumbs up. Awesome. All right, so civilian leave. You have several things like Family-Friendly Leave Act. There's a lot of these that have the word family in it, so make sure you know the differences. The Family-Friendly Leave Act says an employee can use up to 104 hours of their sick leave to take care of a family member. And I am the perfect example. I have a family member that's ill, that cannot go out on their own. And so I am entitled to use some of my sick leave to take care of that family member. There's the Family and Medical Leave Act that says it provides 12 work weeks of job-protected paid leave. What does that mean? It means if I put in for Family and Medical Leave Act, there's 12 work weeks that I may not get paid, but I will still have my job if I have to stay home for 12 work weeks, which includes for adoption or birth of a child. This one just took effect January 2023. So it's pretty new. So federal leave sharing program. There's also on the civilian side, there's a leave sharing program, but I think I don't know if it's sick leave or annual leave. Yeah, I'm not sure. I think it's sick leave because I've experienced the sick leave side of it. If you have an employee that's, let's say they have a terminal illness and they have to be out consistently and they've used up all their sick leave. Well, if there's other employees who wants to donate some of their sick leave, then there's also a program that in Volume 8, Chapter 5, where employees may be able to donate. However, employees may not donate directly to an immediate supervisor. And we don't want that perception. So if it's your supervisor that's sick and you're the employee, you cannot donate your leave to them. Let's talk about internal controls. You must maintain that separation of duties between the person that's inputting, the employee, and those that are certifying the payment. That separation needs to happen. Employee pay records are kept for how many years? Gerardo, any ideas? I know I put you on the spot here. Go ahead if you know it.
5.
All right, can you hear me? Because I didn't have anyone to check, so I better pause.
Yes, I can hear you. Can you hear me?
And it sounds like I can't hear you. So let me play with this. Okay, I think I can hear you now. Can you hear me?
I can hear you.
Okay. I don't know why I have to keep switching back, but with this new laptop. But anyways, pay records for civilians are kept for how long? That is
It says 56 years.
That is correct. 56 years. Let me close that. All
My
right, let's
Lord.
see what else we have. Then the next function of finance is payment. So we've got the packets together and we know the difference between the military pay and the civilian pay, the different rules associated with it. And now let's go to the third function of finance, or the payment. So everything, just think of everything must have a supporting document. The finance side of what we do is just as similar to the resource management side. There's an order that approves that action. So let's say you have a TDY travel order, DD Form 1610. When it comes to the finance CDFM part of it, CDFM finance piece, you have to know a lot of these documents because now that we've digitized the travel process with DTS, the Defense Travel System, a lot of people are not aware of the DD 1610 is the number associated with DTS when that travel order is approved. Versus the rest of us who've been around for a while, when we used to have the paper copy, we knew that we had our travel order was the 1610. So DD Form 1610 is required. Approve 1610. If variations are authorized, it must be on that order when listed on the 1610. When you return from a TDY, how long do you have to settle your voucher?
5 working days.
5 working days. And I bring that up because we have people that violate this all the time. You have to keep following up for them to settle their vouchers within that 5 days. And the purpose of that, even though it's not directly in the study guide, the purpose of that is to prevent individuals from getting on the delinquency list. Being late settling your voucher does not mean that you don't have to pay the bank. That is an individual expense. So you want to make sure that you settle your vouchers as quickly as possible. And the voucher is the DD Form 1351-2. Why is it not called the 1610-2? I don't know why they didn't make it simple. But the 1610 is the order and the 1351-2 is the voucher. If I have a TDY and the TDY covers 2 months, when do I settle my voucher?
It's a window of 30 days.
30-day window. So if it's 2 months, at the end of the 30 days, I need to settle a partial voucher. Again, all of this is timed out so you can pay your card, because the credit card is still charging. And if you got personal credit card, you know they're not waiting until, oh, let me wait till 2 months once you finish your trip, then you settle. No, every 30 days you should be settling partial vouchers. Now let's talk a little bit about PCS, permanent duty travel or permanent change of station. You must understand that when you go PCS from one CONUS location to another CONUS location, the gaining organization provides the funding. Their funding goes on your order. If you're coming from overseas to a CONUS location, the overseas location pays for your travel. If you're coming from stateside going overseas, then the gaining unit pays. Let me make sure I said that. That is correct. The gaining unit. So it almost seems like if you're overseas, the overseas unit covers all the orders. Let's talk about payments to vendor, and I touched on this in the beginning. Any payment we make must have a packet, some type of packet that has the contract, the invoice, receiving report, and all of this good stuff that goes with that contract. So the invoice must have several items. And this is important to know because, again, whenever you have a list of things, as a multiple choice test writer, I'm going to add something that doesn't match and then say which one is not a part of the invoice. Then you should be able to pick which one is not. So you must have 10 things. So of the 10, just kind of read through it. It makes sense. If you've ever looked at an invoice, name, address of the contractor, the invoice date is important, contract number, the vendor invoice number, description of what was delivered, shipping, payment, tax ID, banking information, contact name and information, and any other documentation that is required for that packet. Make sure you at least learn those top, I'll say 4. And I also, from a real world scenario, see people that were paying an invoice, and I looked at the document, I said, this is not an invoice, this is a bank statement. Because if I don't see something say invoice date and invoice number, then that is a bank statement. So make sure that you're using the invoice. Then you have a receipt of goods, the goods receipt saying I got the items. Then you review them, make sure that if I ordered furniture, that the furniture wasn't broken. But if it's good, then you have acceptance of the goods. Prompt Payment Act is very important when you deal with paying contractors or paying contracts. Under formerly 31 U.S. Code 3901 used to be OMB Circular A 125. What it does, it requires agencies to pay their obligations within time periods. And then you pay interest if you're late. No different than your personal lives. Is you have a certain date, you got to pay. The difference with the prompt payment, if the contract says that you can pay this contract within 10 days and we'll give you a discount for this, you want to try to pay it within that 10 days because you want to pay at cheaper cost. If you receive what you need, go ahead and make the payment, or else you pay the full amount within 30 days. That is why it's important to get a copy of the invoice immediately after you accept the items, because that clock will start ticking Once they give you an invoice, and that invoice date will determine when does the 30 days end, where they start charging you interest. Any question on Prompt Payment Act or anything I've covered so far before we go into reporting? Welcome, Mr. Lincoln. All right, so let's go to dispersing office reporting requirement. As I mentioned, when it comes to the finance piece of the CDFM, you will need, even though I haven't seen the exam, but the majority of this section deals with finance forms. So you need to know the daily statement of accountability. That's the daily report. Which ones are daily, which ones are weekly, monthly, however often they're done. So daily statement of accountability, that's the DD form 2657. Now, maybe it'll help if you put all the DD forms together and then separate the 26. If you put them in numerical order, maybe that'll help, but you can break the list up so that you can remember. The deposit ticket is the only SF 215. That's the only SF1 that you deal with. That's your deposit ticket. Voucher control log is essential in the finance. That's another daily report. That's the 2659. So I recommend, if you have several DD forms, put them in numerical order and then look at which ones are daily versus monthly and so forth. Then collections. So now that we've paid funds out, sometimes we have to collect because the government is owed some type of funding for whatever reason. Either you lost an equipment or you got overpaid for something and we got to get a refund back, or you have to pay the government. So there are different types of collection. You have receipts, reimbursements, refunds. That's the 3 R's. And then I'll go over the other ones shortly. So receipts are collected on a DD form 1131 CCV, cash collection voucher. So that's the only one where you will see the 1131 is in the collection section. So cash collection voucher or the CCV, if it's make sure you know if it's an acronym, know what the acronym means, because oftentimes they might put an acronym, and then if you don't know what CCV means and they don't put the 1131, then you may not be able to decipher it. Reimbursements are amounts earned and collected for property sold or services that are used by another government agency, shown as a positive number also on the DD 1131. So reimbursement is money that's owed back, being reimbursed to the government. And then refunds are recoupment of excess. That means you got a payment and we paid you too much, so now I need a refund to recoup excess. So this is basically definitions and understanding what those definitions are. There are also some indirect collections or monies collected by collection agencies. So when I talked about those non-discretionary allotments, it could be an indirect collection. You didn't ask for it, but somebody's, based on you owing somebody, it was started. So agents such as the commissary, sales officers, property disposal personnel, and other officers authorized to receive funds due to the U.S. government. There are 4 collection systems that are used. Nope, I've never used any of them. Government Online Accounting Link System, that's the GOLS 2. The Intergovernment Payment and Collection, that's the IPAC. And the Central Accounting Reporting System, the CARS, government-wide TAS ATB system. All I know is all 4 used for collection. Then there's debt collection. So before I move on to debt collection, is there any question from anyone on the live session? And then if you're watching the video later and you have a question, please leave a comment under the video and I will get back to you as quickly as possible. Okay, I don't hear any questions, so let's move on. Debt collection. When you owe the government money, so depending on your disposition, if you are a current employee and you are notified of a debt and you don't pay it within a certain time frame, then they do salary offset. They take it out your check. If you you owe a debt and you are a previous employee or formerly employed by the organization, you will be receiving a debt notification. They'll give you a timeline, and they will also try to see if they can, if you're working, if they can do a salary offset, or in most cases, it'll be referred to the IRS. So whenever you submit your taxes, if you're owed a refund, then the debt will be repaid first and you get the remaining refund. Debts due from a contractor. There are thresholds for referring contractor debts to the debt management office. That's the DMO, debt management office. So if the debt is $25 or more, if the contractor has a TIN number, or $100 or more if they do not have an identification number. Debts must be forwarded to the DMO, debt management office, no later than 90 days following the debt repayment due date. So after the due date, within 90 days, then you can submit to the DMO. In most finance office, you have a debt section. We had a debt section, and then at DFAS, there's also the debt management office that we dealt with. The do not pay initiative is also called a holdup list, and is not a list of contractors who shouldn't be paid. What it is, it provides data sources to determine who is eligible to be paid, such as, such as data on deceased individuals. So that do not pay list is if a name comes up and then they identify, hey, this person is deceased, we probably shouldn't make that payment, or not probably, don't make the payment is basically what I'm saying, because he has a list of names. Or entities that are barred from receiving money from the federal government, their name may be on the list. So the do not pay initiative is different than the, hey, this is a list of people who you should not pay to. And I'm trying to refer to, like, when we were deployed as finance, we had a list of contract companies that we could not cash their checks for. If they work for that particular company, we could not cash their check. So it's something similar to that. But the do not pay is more specific to the individual, not an agency. All right, dispersing officer accounts, irregularities. What you'll know if you ever have to work as a dispersing agent, dispersing officer, or somebody who actually certify direct funds outside, not the resource management side, the finance side, then if you actually are responsible for cash, you have to record every transaction if you're out of balance. And what does that mean? That when there's an irregularity from what you had at the beginning of the day, the amount of transactions that occurred, at the end of the day, you must account for every dollar. So you're either going to have a major loss or a minor loss if it doesn't balance. Out of balance, it simply means I can have a major loss, which is over $750, or a minor loss, that means it's $750 or less, not involving fraud. I don't suspect any fraud. And you can lose when you actually deal with cash. And as a finance officer, we deployed and we actually walked around with thousands of dollars to go pay soldiers. And sometimes your cashiers, because again, you got to learn how to count, right? We're used to using we don't have cash registers. So you have to be able to count. And sometimes here or there, they may be off. But if it's less than $750, $150 or lower, then it's considered a minor loss, but still must be reported. You can have a term called check issue overdraft versus underdraft. It means the amount of the check is greater than the amount recorded. That means somebody made a mistake. If the check, because we have to document every check that's written, if the check is $100, but I wrote it for $200 when I wrote it on my log, then that is a check issue overdraft. The amount of check is higher. No, the reverse. That's the underdraft. The amount of the check is higher. So the check is 200, but then when I wrote it in my log, I wrote 100. So the amount of the check is greater than the amount I reported versus an underdraft. The amount of the check is $100, but I reported that I wrote a check for $200. So we cannot have no discrepancy with the finance, even if it's $1, because it makes it look like you can't put money into the cash register. All right, delivery of check. And so the dispersing officer will attempt to deliver checks within a 60-day period. Somebody is owed a check, they mail the check to the individual based on the address that's in the system, and nothing happens. They don't cash it. Then they resend it if necessary, but it is determined to be undeliverable after 60 days, after sending out the check. Now, as a dispersing officer, they must report the undeliverable checks on an SF 1098 to credit back to original accountability. So this is not the same thing as when you get like DFAS issues a check or something like that, you get a check. Is usually on the check, it'll tell you how long you have to cash that check. You may also deal with spoiled check. Spoiled check is simply, I received a check from the government because I'm owed it. However, I was drinking hot chocolate and I spilled the hot chocolate on it. Now I can't take it to the bank. I cannot scan it. I cannot get it deposited into my account. That is considered a spoiled check. It does not mean that I'm out of my money and I'm not going to get my money. It now means that I need to send back that spoiled check to the dispersing officer that sent it to me, and then they will reissue a new check if you're authorized. The Borrowing Act is a law that requires government agencies to receive a claim within 6 years of the claim accruing. So if the government, and I think the same thing, if the government moved your household goods and something was destroyed, you have a timeline of when you need to submit your claim. So under the Borrowing Act, that is the law that says the government must receive that claim within 6 years of when that claim accrued. And this applies to both military and civilian personnel. Any question of the finance portion of the competency number 3.1? All right, so we got some time. So let's go ahead into competency 3.2, accounting. And I'm just going to tell the story. So the overview of accounting. Now, before you look at the accounting, you got to recap some things that you should already know. The authorization law versus the appropriation law. So when you do, you pause. What do I know about the authorization law? It authorizes the programs. It doesn't matter if funding is listed. I don't get any budget authority from the authorization. The appropriation law, and you can go the extra step of saying which House and which Senate is responsible for it, but the appropriation law is what grants us the budget authority to obligate funds. It provides the legal authority to operate and fund these programs. So when you deal with accounting, which is the section we're on now, there's 3 types of financial reports that we deal with. We deal with the balance sheet, the statement of net cost, and the statement of change in net position. And we're going to go into details with those because you're going to have those are the formulas that you have to learn. So there are three agencies that's directly responsible for implementing accounting standards. You have the GAO, Government Accountability Office. They work directly for Congress, and they provide the generally accepted government auditing standards. That's the GAO Yellow Book for auditing. You have the OMB Circular A136. That is the OMB's guidance on the accounting standards. And the Treasury also provides and performs basic functions associated with the accounting. Because again, the Treasury is the nation's bank. And so those ledgers is what they keep track of the monies that come in and out of the Treasury. Talked about that. You also have the Federal Accounting Standards Advisory Board. This particular board was established in 1990 by the Comptroller General. Anytime you hear the word Comptroller General, that lets you know that is the senior individual in charge of GAO. So even if it doesn't say GAO, you know that Comptroller General and GAO are simultaneous. The Secretary of the Treasury and the Director of OMB. So those three agencies came up. They all sit on the Federal Accounting Standards Advisory Board, and it is their job to provide the generally accepted accounting principles, the GAAP, for the federal government. So there are other boards that provides us with accounting. Financial Accounting Standards Board, they issues the standards for accounting. The Government Accounting Standards Board, they also issue the accounting standards for state and local government and not-for-profit entities. You have the Federal Accounting Standards Advisory Board, was finally recognized as the body designated to establish the accounting principles for the federal government in 1999, that the FASAB. And then at the DoD level, you have, as we mentioned a few seconds ago, the USD Comptroller. That's the principal advisor. So anything dealing with financial management, accounting, finance, it is the USD Comptroller that provides the advice to the Secretary and Deputy Secretary of Defense for budgetary and fiscal matters. They are the CFO, and they direct whoever this USD Comptroller, they direct DFAS in this whole accounting and finance process in the DoD level. So if you notice at each, you need to know what's going on with Congress, that's GAO. You need to know the executive branch has the OMB. The DoD has the USD Comptroller. So depending on what level you are will determine what they can or cannot do. Any questions of me thus far? All right, let's switch gears and go to appropriations life cycle. And all of this, to recap, if you took module 2 or module 1, you're going to see the same thing again. You have every appropriation has a specific timeline. So your annual appropriations are your O&M and your MILPERS, military personnel. You have your multi-year RDT&E procurement, MILCON, and shipbuilding conversion Navy. What you also need to know with the multi-year is RDT&E is a 2-year, procurement 3-year, shipbuilding conversion Navy and MILCON are 5-year. Those years mean that you can go enter into new obligations with those appropriations within those timelines. So those are the fiscal law restrictions that Congress placed on the use of those appropriations. So as I mentioned, fiscal law is rolled up in these competency. Flow of funds says that once Congress appropriates the funds, two things happen. The Treasury issues a Treasury warrant or the appropriation warrant, which is the legal notification that the appropriation has been enacted, and then OMB begins the apportionment process. The agencies will submit their SF 132 apportionment request to OMB within 10 days of the enactment. The agencies request their apportionment. And then OMB has 30 days to send out the apportionment. The agencies will then take their funds and issue allotments to their subordinates. Then everyone will commit legally, binding the government in an obligation, and then outlaying those funds. When the funds are removed from the Treasury to pay and liquidate an obligation. So commitments happen before obligation. Just kind of make sure you understand the flow of funds and what happens, when it happens, and so forth. Know the difference between a transfer and a reprogram. Transfers are done between different appropriations. I want to take money from MILPERS, put it in O&M. No, I don't have the right to do that, so I have to get approval. So depending on the thresholds that are established when I receive my funding, my allotment will determine whether I can transfer or reprogram. Reprogram means I'm within the same appropriation and I'm just reprogramming within SAGs, sub-activity groups, and so forth. The other type we deal with is defense working capital funds. Those are funds that earn their budget authority by charging customers for their goods and services. Commissary, for the perfect example. Remember your working capital fund? The goal of the working capital fund is to break even over a long term. It's not to earn a profit. So if at the end of the fiscal year and they consistently earn a profit, then pretty much the price needs to start coming down for those goods so that they can break even. Working capital fund agencies can be closed for two reasons. If the president or the head of the agency, whoever's in charge of the Department of Defense, says that we no longer need that service, you can end a working capital fund. Or if there are no sales within 2 years of operation, then you can close that working capital fund. Then we move on to continuing resolution, which now, as of this date of this video, we are under a year-long CR, which means depending on how much money we anticipated to get, what we currently have, we are anticipating taking budget cuts that we weren't expecting before. Now that we know we're not getting the budget that we anticipated. So there are budget cuts that are coming because a continuing resolution is a temporary appropriation law that what it does, it restricts us to previous fiscal year spending or rate of operation. So the amount provided for the CR is based on current rate. The total funds that were available the previous year, and we must operate at that same rate of operation. When you talk about the life cycle of appropriations, you talk about they are in the 3 phases. Unexpired, which is what we talked about with the timeline, 1 year, 2 year, 3, and 5, or they're expired. Expired, every appropriation stays in the expired state an additional 5-year period. So regardless if the military construction is a 5-year unexpired appropriation after that 5th year, then it's an additional 5 years in the expired state. The only thing you can do when appropriation is in the expired state is make upward or downward adjustments. That means the contract was already awarded before it entered into the expired state. The requirement was approved. You had a contract. So, as one of the questions I received on Facebook, if that contract was not satisfied in that year, then let's say we're in a new fiscal year and they still need that contract fulfilled, that is your grounds to use that prior year fund because you were approved, you had a contract, and for whatever reason, for convenience of the government, then that contract was canceled at that time, but you still have the requirement, so that guarantees that you can use prior year funds. And then the appropriations enters the closed or canceled state. When the funds enter this state, the funds are then removed from our accountability up to the Treasury into the miscellaneous receipts account. However, we can use the 1% rule that says if I receive an invoice out of a canceled account, and it was not a lot, and I have a lot current, I can use up to 1% of current funds, of course, the same type, to pay on that closed account. Now moving on to obligating documents. There are different kinds. As I mentioned, before we take any action, whether you're doing the finance function or the accounting function, we must have the approved obligating document to obligate the funds. Primarily, we use contracts, which are that enforceable agreement between the government and the vendor, or MIPRs, military interdepartmental agreements that we use to communicate and to get services. Understand that when you do a MIPR, your MIPR is either a project order or an Economy Act order. Know the difference. Project orders are done between two DoD organizations. You do not obligate the funds because you're still within the Department of Defense. And project orders are covered under Title 41 U.S. Code versus an Economy Act order, which is a severable MIPR that says you must obligate this fund by the end of this fiscal year, or else I can deobligate remaining funds at the end of the year. Economy Act orders are covered under Title 31 U.S. Code. The Economy Act for both MIPRs, you're using the 448 as the MIPR and the 448-2 as the MIPR acceptance. You use the Economy Act order if we are doing business with another, it's intra-government. So that means I can enter into agreements with other government agencies using the Economy Act order as on that MIPR. 9 times out of 10, your project order is tied to some type of contract. So you do not deobligate funds at the end of the fiscal year. So just know the difference between when the order is a project order on your MIPR or an Economy Act order. Earlier, we touched on reimbursements, refunds, receipts. So reimbursement, that's amounts that collected for selling goods or services. I already did the work. Now you need to reimburse me for the money. Refund is I'm recouping because I paid you too much and now I need to recoup. Outlay is another term that you must be familiar with in any one of the CDFM. That is the same thing to us as a disbursement. But the formal definition is when the funds are removed from the Treasury to liquidate an obligation. Another term you must be familiar with is the Future Years Defense Program, the FYDP, the FYDP. This is also in Module 2. and touched on in Module 1. The FYDP is the DoD database that allocates resources, forces used by the different agencies and equipment associated with, I think it's 12 major force programs. So remember we said the authorization law authorizes programs? Well, the Department of Defense have about 12 programs that they function out of. And so the Future Year Defense Program takes those programs and it aligns with different services, Army, Navy, Air Force, Defense, and the equipment that are used to do those, the appropriations that are used. So FYDP is three-dimensional. So whenever the components submit their POMs, the information is used in the FYDP to update the OSD cost estimate. That's done by the Director of Cost Assessment and Program Evaluation, the DCAPE. And so the DCAPE, that's the individual, the title of the individual responsible for updating the Future Year Defense Program. As they go through the POM process and approvals are made, they update, the DCAPE updates. So the Future Year Defense Program includes 10 years of data, which includes prior year, current year, budget year, plus 4 additional years for the resources, and an additional 3 more for the force structure. So that's the POM side. The FYDP also works and coincides with the budget side. You got your program where you do your POM, and then you have your budget estimate submission, your best. That's the process that they request the budget with. And so all of those try to coincide with each other, but they don't always have to equal because they go through different channels. So once the president's budget is submitted to Congress, the Future Year Defense Program data that's in the FYDP becomes the starting point for the next fiscal year. So whatever they finalize at the DoD level that they're going to submit to the OMB, then that becomes the starting point for them to start again for the next. All right, so let's look at some federal accounting systems. I'm just going to name them. There's 3. You have, and I think we touched on the IPAC already, Intra-Government Payment and Collection. That's the way to transfer funds from one agency to another. Dispersing Payment System, where DFAS uses, that's the automated payment system that DFAS uses. It's called Dispersing Payment System. It's different kind for each of the services, the Army, the Navy, the Air Force. And then you have the collection and reporting systems that we touched on earlier that provides agencies with up-to-date balances and transfer information needed to reconcile processes. So collection, dispersing, and the collection has 2 different systems. That's the Government Accounting System, Statement Module, and the IPAC. All right, let's dive a little bit deeper into the accounting. So we touched on this when we went over the accounting. We said that federal accounting has 3 different accounting systems, 3 types of accounting: budgetary accounting, proprietary/financial, and the third one is managerial cost accounting. Make sure you review the chart of accounts because that serves as the basis for the general ledger that's kept at the Treasury and how we keep track of federal accounting. You have the series number from 1,000, that's a bunch of zeros, to 8. They all mean something. So your 1s are your assets, 2 liability, 3 net position, 4 budgetary, 5 revenue and other financing sources, 6 expenses, 7 gains and losses, 8 memorandum. If you say it enough and think about it, then it'll be easier to remember. So we pulled out initially, we said budgetary accounting, proprietary/financial, managerial. So keep that in mind, 3 types of accounting. So in budgetary accounting, that's the first accounting system That means all your accounting numbers start with a 4. The formula for budgetary accounting is resources, that's the list of the resources, equal the status of those resources, whatever you did with them, wherever you sent them. They must be balanced. Second accounting system is proprietary financial accounting. That's when you come up with the balance sheet. You must know the formula for the balance sheet. And if you remember back to the series of numbers, the 1, number 2, and the 3, assets equal liabilities plus net position. That is the formula for the balance sheet. Then under proprietary, you have a second formula, which is statement of net costs. That's your expenses minus your revenue. Expenses were your 6 numbers, starts with a 6, minus your numbers that start with a 5, that equals your net cost. Now, what do you need to know the formula for? Because they're going to give you numbers. They're going to say asset 1000 and a dollar amount. They're going to give you liabilities. They're going to give you the number, and they're going to give you a dollar amount. And they're not going to say, well, this one's an asset, this one's a liability, this one's, no, they're going to give you the series numbers. Because if I'm a test writer, that's what I would do. I would give you the series numbers, a bunch of numbers, and depending on what it starts with, will let you know what it is. And then I'll say, calculate the balance sheet. So if you know the formula for the balance sheet, you know it's the first 3 numbers. And no, on an exam, they're not going to put it in order for you. So you're not going to have it from 1 to 8. It's going to be mixed up. So just kind of review this section to make sure you understand. And my advice, when you take an exam and things are out of order, before you even answer the question, you usually have a scratch paper, put it in order first, and then go back to the question and answer the question. Any question of me? All right, and then I think, okay, so that's that. And then you have the third accounting system, which is managerial cost account. That's the next level up, the supervisory level. It says the SFAS for defines managerial cost accounting as the process of accumulating, measuring. Okay, you can kind of read through that on your own. I focus on the ratio analysis. As a manager, I want to know what's the impact of our operation, not the day-to-day. I want to know what's our current ratio? What is our ability to meet our current obligations? What's our ability to meet and pay our bills? The goal is 2 to 1. I want to have more assets, less bills, 2 to 1 or better. So I add up my cash, accounts receivable. So receivable means somebody owe me money, and my inventory. Those are all my assets, divided by my liability, what I owe. That will tell me my current ratio. And then my quick ratio says that maybe I don't have time to check the value of all my inventory. And so I just use my cash plus accounts receivable divided by current liability. And that's my quick ratio. That tests my ability for immediate solvency. If I need to disband the organization, sell off things, how quick can I do so? What's my solvency rate? So the goal is 1 to 1 or better, meaning I break even basically is what's going to happen here. And then we move on. So we've accounting for all our transactions, but then you got to have the auditing side. I know my day-to-day operation, but we make mistakes. And oftentimes it takes the auditing organization to come in to help me see my blind spots, to help me find areas that I need to improve on. And so in auditing, which are usually conducted by the GAO, or if you fall in the Department of Defense, you may have DFAS that comes in and audit, but your hire will audit. Internal controls is what we do on a day-to-day to make sure that we're following the standards and policies and procedures. And an audit is when you have an outside entity coming in to evaluate your operation. So based on the Chief Financial Officers Act of 1990, that required every agency to have an auditable and transparent financial management process or system. So that's the law, CFO Act of 1990. There are different types of audit. You have financial audits, that's the finance systems that we use. Performance audit, that's how we do our job, because you got to be audited with our process. Again, I can't have the same person inputting and certifying their own actions. So that's a performance that will have to be evaluated. And then you have attestation engagements. So this type of audit means I requested, hey, I want you to come and inspect my travel system, my travel process. Please come in and audit. You request it. So you have a set amount of procedures or a set topic of what that auditor is coming in to review. So that's the difference of an attestation engagement versus financial and performance audit. The GAO standards that are listed in the generally accepted government auditing standards, the GAGAS or the GAO Yellow Book, is auditor independence. Again, for all the reasons which you can tell why you want your auditor to be independent. We don't want any self-interest threats because I'm in the chain of command, self-review, biases, and so forth and so forth. Auditor competence, your auditors must be trained. They must complete CETs or CPEs, 80 hours within 2 years with a minimum of 20 hours completed in any one of those years. And at least 24 of the 80 must be directly related to auditing. We have quality control and assurance. That's another one of the GAO standards. That agency must also be evaluated by another audit organization every 3 years. GAO, again, is headed by the Comptroller General. That name, that CG, shows up in the CDFM all the time. It's not the general that runs that organization. It's not commanding general. It's Comptroller General in charge of GAO, and they serve 15-year appointments. They're appointed into that position, and they serve for 15 years unless they're fired. There are several DoD audit agencies. You have the DODIG, Inspector General, Army Audit Agency, Naval Audit Service, Air Force Audit, and the DCAA. That's that Contracting Audit Agency. There are 5 phases of an audit, even though the book shows maybe 2 or 3, I think. There are 5 phases. There are different things that must happen before you plan and at the end after the auditor is done, even though it's not a formal stage. So they plan for the audit because you want to determine the scope, the objective, what are we trying to accomplish? And at the same time, the organization is conducting internal controls. You don't want to wait till someone's coming in to audit to then start doing QC or quality control. Then you review. After they put the plan in place, they send a checklist oftentimes, and they'll come out and review, gather evidence. And then they report your benefit, your impact can either be monetary impact or non-monetary. It enhances safety or it's a threat to safety, morale. And then the auditor will provide their recommendation or notice for recommendation. And so that is a step that I added, but based on conversations from other people, it's not just the 3 phases of the audit that ends right there. Once they review, then it ends. Understand that the auditor also give their opinion at the end. So even if it's not listed as a step in the book, understand that that happens. The NFR, notice for recommendation. Right, so digital dashboards are different technologies that are used to help reflect and show the data in real time visibility. Smart contracts is how they automate the execution of the contract. So a lot of technology is used in most instances now to kind of streamline and make things more visible, where you can get a quick status of the operation in the auditing and the finance and the accounting of your operation. All right, looks like I'm at the end of the review of CDFM Module 3. Do you have any particular question? My Lone Ranger, do you have any question on the live session? Because if not, we're going to end for today. Then I think what I'll do, go ahead, sir.
No, I don't have any questions.
No questions? Okay. And so what I typically do at the end, because I'm not going to repeat this next week, is the same thing, is I will pause for a week or two to allow you the opportunity, or for those that are preparing to take the Module 3 exam, to zoom in on your studies, schedule your exams, and go ahead and take the exam within this break before we move on to Module 2. Module 2 is a beast in most cases because it has a wealth of information. It's going to pull information from Module 1 and Module 3 and have its own, which includes additional formulas you're going to need to learn. So go ahead and get Module 3 out of the way. If you have questions for me, either email me or put the questions under the video in case somebody else has the question and didn't know how to ask the question. All right, since we have no other questions for today's session, I'm going to close out by saying again, please go ahead and subscribe if you haven't already done so to our YouTube page. We also have a Facebook page out there, a LinkedIn. I try to get the information out as much as I can, but go ahead and feel free to spread the wealth, let people know about the CDFM YouTube page, and make sure that if you have questions in between the breaks, that you reach out to me so I can clear up any questions. If you're reviewing a video and you see something and hear something that doesn't sound right, send me a message, because maybe I missed it. I'm a one-man show, a one-woman show, so sometimes I may miss something. I will go ahead and correct it. All right, this is Helen Thomas and the CDFM Study Group. I'll see you guys again next time. Thank you for stopping by.
Thank you.
Thank you. Have a great day. Recording.